Hello everyone, welcome to today's webinar, Career Insights, Quant and Factor Investing, hosted by CFA Institute and CFA Society India. I would like to take a moment to welcome our audience from around the world joining us remotely. Hi, I am Litesh Gada, founder of Aureus Asset. We are into business consulting, valuation, and transaction advisory. Before I introduce our speaker, I have a couple of housekeeping notes. Today's webinar is scheduled for 60 minutes, including Q&A. 45 minutes of presentation and last 15 minutes will be for the Q&A session. We will be leaving time for Q&A after the presentation. Please feel free to submit your questions throughout the presentation. You can do so by clicking on the Q&A icon at the bottom of your viewer and typing your question in the box. This webinar presentation will be available to view after the presentation concludes in the chat box. We value your feedback, so please complete the evaluation survey before you sign off for the day. It is my pleasure to introduce our speaker for today's webinar, Dr. Tarun Sanghi, CFA, the senior quant at StarMine, which is now part of London Stock Exchange Business Group, which is LSEG. His works involves the application of his computational and statistical expertise to develop data-driven quantitative models for stock selection, risk estimation, and portfolio optimization. Tarun has been leveraging his multidisciplinary background to solve quantitative equity investment and portfolio allocation problems for more than 8 years. Before joining StarMine, he was a research analyst at an Asian and emerging market focused hedge fund group and a quant strategist at a US equity focused hedge fund group. He has received his bachelor's degree in physics from BITS Pilani, India, and a master's degree and doctorate in mechanical science and engineering from University of Illinois at Urbana-Champaign, USA. He was awarded the CFA Charter designation in 2022 and is currently a member of CFA Society, San Francisco, USA. Over to you, Tarun.
Thank you, Litesh, for that introduction. Hello, everyone. Good evening. I am Tarun Sanghi. I am a senior quant at StarMine, which is a part of London Stock Exchange Data and Analytics Group now. And today I am going to talk to you the basics of quant and factor investing. Before I do so, let me give you a quick introduction about StarMine. So StarMine was started in 1998 in San Francisco, and we are best known for our ranking of sell-side analysts. So basically, we use data to understand some of the biases that analysts exhibit when they make their estimates available. And then we understood some of the constraints that they meet with, especially with regards to what stocks they get to cover. And we combine all of this together to come up with a data-driven, statistically rigorous process, which would allow us to rank them. So that was our name to fame. And back in the day, our proprietary approach was used by a lot of brokerage houses to rank their own analysts. So that was the very first thing we did. Having done that, we used that approach to develop what we call as smart estimates. Before I talk about that, let's look at how this analyst estimates are used by investors to make their investment decisions. So let us say you have a stock and you have 2 or more analysts providing their estimates. They might be providing earnings estimate or revenue estimate, which is what these investors use to analyze a company and then make their future investment decisions, right? So if you have 2 or more analysts, what investors typically do is they would average their estimates and then would use that average estimate to make their decisions, right? So what is at play here is they are using this statistical concept of wisdom of crowd. So by averaging, what they're hoping is the noise would get canceled out and the true signal or the true estimate would be amplified. So it should be better than the point estimates of the 2 analysts. And it works. Wisdom of crowd really works. So we took one step further because we had this algo that allowed us to identify top rank analysts. So instead of doing this equal weighting, we allocated more weight to a higher ranked analyst and his revisions. So instead of doing this blind equal weighting, we did this unequal weighting and developed our estimates, and those estimates were called smart estimates. And what was found was whenever smart estimates deviated from this consensus, by consensus I mean this blind equal weighting, by more than 2%, then smart estimates were found to be 70% times directionally more correct than these consensus. So that's how we developed these smart estimates. And once these were developed, we started using them as input to our stock selection and risk mitigation models. And that was our entry into building these factor-based quant models that clients buy from us. At a very high level, we combine classic quant with data science and state-of-the-art ML and AI to build clear box models. All right. So with this introduction, let's come to the main topic, which is factor investing. So let's start with uh, trying to define what factors are, or develop an appreciation for the concept and the framework before we get to the factor investing. So factors can be defined as these distinguishable attributes that can be used to explain the historical performance of an asset. And when I say historical performance, I mean their risk and return profile, essentially. So to understand factors, it's always helpful, or I found it helpful to think of this food nutrient analogy. So basically, you've eaten a burger, right, for your lunch. But what is it that you are providing to your body for it to function properly? Yes, you've had burger, but through burger, you are trying to provide fat, protein, carbohydrate, vitamins, and minerals, which is what your body needs to function properly, right? So in similar spirit, factors are to assets what nutrients are to food. So assets can be thought of as bundles of factors. Like a burger or a pizza is essentially a bundle of these essential nutrients that you need to to have your body function properly, right? And I would show you this factor risk is the driving force behind the assets risk premium, right? So factor essentially sits in between your assets and portfolio, which is shown in this chart here. So you could use factors to understand assets, their underlying characteristics, and then use those characteristics to build a custom portfolio which suits your need. So again, bringing back the food nutrient analogy, you go and see a nutritionist and he or she helps you devise a plan, a diet plan that is best suited for you, right? So similarly, you could use factors to understand these assets, their underlying characteristics, and then you use those to build a custom portfolio which suits your need. So that is how factors sort of neatly sit in between assets and portfolio. You could use factors in reverse as well. And if you look at the literature, academic literature, this is how factors were discovered. You could start with a portfolio and then use factors to analyze it. You could use factors to try and figure out what are the exposures that the portfolio had which allowed it to behave the way it did, and then as well understand what are the different risks that you took for the performance that you've realized from the portfolio. So factors can be used in both these ways, and this is what I describe in this little box here. If you're starting with a portfolio and using factors to do risk and return attribution, that is typically called as portfolio management. And if you are starting with assets and you are using factors to understand them and then use those factors as sort of a knob that allows you to build these custom portfolios which are best suited for your needs, that is what is called as the portfolio construction. All right, with this high level understanding, let us talk about factor models. So factor models are nothing but a mathematical framework that allows you to study the risk return profile of an asset. So the reason they are called models is, unlike nutrients, there is not unfortunately, there isn't a finite set of factors that could be used to explain the complete return and risks of an asset. So if it were, then it would not be called model, it would be a law. So unfortunately, we do not have a finite subset that can be used to explain risk and return profile of every asset, but you do build these models which allows you to understand that risk and return profile for the specific asset that that you are interested to study. So factor models are essentially that mathematical framework that you are using to study that asset. Uh, the the first model that I want to talk about is this capital asset pricing model. It was formulated in 60s. It was a one factor model, and that one factor was the market. What it said was, you can look at this equation. The left hand side is the return that you expect from an asset over the risk-free return, and the risk-free return is typically the return of a government bond or a treasury in US. So if you are expecting a return above the risk-free return, then that would come through your exposure to this one factor, which is the market. So if and that quantity of it is controlled by this constant called beta, which is your exposure to the market. There are two securities. One has a higher exposure, meaning higher beta. So that is expected to have higher asset premium, like this return of the asset minus the risk-free rate is called as the asset premium. And another security which has lower beta is expected to have a lower asset premium. So basically what it said was, it's this one factor which is the market, and you are, by investing into that asset, you are taking on that market risk, and you should be compensated for taking on that market risk. And how you should be compensated is controlled by this factor beta, which is your correlation with the market. So that was the first model that sort of allowed us to think of the returns in terms of the risk of these underlying factors. Of course, today we know that CAPM alone isn't enough to explain the cross-sectional returns, but the basic intuition that it is not this asset, it's exposure to this risk factor called market in CAPM, which gives you this asset premium, still holds true. And it's funny. If you would look at the literature on factor research, you would find most of these models were developed to explain the returns, the superior returns of super investors like Benjamin Graham and David Dodd. So what was found was, using CAPM only allowed to explain 50 to 60% of the returns of their portfolio. So the researchers knew there's something else that is missing in the model, which would be needed to explain this residual return. So that led to the development of what are called as the multi-factor models. So the basic construct is very similar to CAPM. You are trying to explain some return, and you are trying to explain it as the risk-free return plus some linear combination of the factors. They could be market, they could be fundamental, they could be macroeconomic factors. And the hope is this pool of factors that you have would allow you to explain excuse me, the cross-sectional returns of the assets that you are working in. Multi-factor models are usually put in three types. First is this macroeconomic factor models, where these factors are the macro variables. Most practitioner models, one could use these economic variables, but they use first order change in the macroeconomic variables. So basically, take inflation. Inflation impacts the return, but it's the change in inflation that impacts certain assets more than the other. So it's the first order change of the economic variables, which is used to design these macroeconomic factor models. Then you have fundamental factor models, and we would be studying them in little bit more detail in this talk. So here you are using asset specific attributes to define your factors and then using them to explain the returns. And then the third type is statistical factor models. Here, you are working with a pool of factors, but you do some mathematical transformation that allows you to analyze the collective behavior in a statistically rigorous manner. So that sophistication has certain advantages, but then it comes at a cost. There, the interpretation of which is the most dominant factor at times is hard to infer. But another style or approach wherein you use a pool of factors to understand the risk and return profile for different assets. All right. So having gathered that background, let's look at some of the well-known equity factors uh, which are there or which are discovered. So the first one is value. So value essentially captures the excess return of stocks which are undervalued. So basically it says your undervalued stocks would outperform the overvalued stocks, but we have not yet defined what is undervalue. So I would come to that, but that is what was found, and that premium is what is called as the value premium. Now to define under and overvalued, there are multiple approaches. The first or the more famous one is what is called as the intrinsic value, where you are using your estimates of expected future cash flows that you would be receiving from the company. It could be in the form of dividends, or you might be forecasting cash flows or earnings, and then you discount it back to the present value. So once you do that, what you get is what is called as your estimate for the intrinsic value, or your estimate of the fair value. And then you compare that value with the market price, and if it is lower, then it's overvalued, because market is valuing more what you feel is its true worth, right? And vice versa. And the second approach is the relative valuation, where you're using these fundamental item-based ratios like book yield, earnings yield, book to market value, price to earnings, cash flow yield, to cross-sectionally segregate undervalued and overvalued stocks. So that is how you define a value factor. When you're working with factors, first thing is you come up with a construct that allows you to harvest that premium. Second thing is, once you see that there exists a premium, you should spend some time trying to figure out why that premium exists. So there should be a strong economic rationale for why that premium exists and it hasn't vanished. So if you are able to come up with a sane risk-based explanation, hey, that premium exists because I am taking this additional risk, then that is what is called as the systematic risk-based explanation for that factor. And a lot of times what happens is you have seen a premium to exist. Unfortunately, you do not have a good understanding of what is that systematic risk that you are taking, which is giving rise to that premium. But then what is it that's causing it. The certain behavior of your market participants, or certain structural things or dislocations in the market is causing it. So if you have such an explanation for why the factor premium exists, then those are called systematic error or behavioral finance-based explanation. As a practitioners, you do not get into the weeds of it, but then you should always design some ancillary tests to figure out what is it that is giving rise to that premium. And the premium exists because the factor doesn't work all the time. If it were, then it's a short winning formula. The fact that it doesn't work all the time is the risk. And when you take on that risk, you expect to be compensated for that risk premium that you have seen while researching the factor. So keep that thing in mind. So that was the value factor. Then you have the size factor, which essentially says that the smaller firms tend to outperform the larger firms. Common constructs are, you use the market cap, sometimes you use beta as a proxy, and then you have other constructs as well. So it's interesting. I talked about the failure of CAPM. It could only explain 60 to 70% of the returns. you add value and size to CAPM, and it becomes what is known as the famous three-factor Fama-French model. And in fact, these three factors were discovered. I mean, there was development going on, but one of the things that these three factors did together was they could explain good 80 to 90% of the returns of these super investors, Benjamin Graham and David Dodd. So again, connecting back to what we said in the first slide, you had some portfolio, which was the portfolio of these super investors, and then you tried to develop factors which would allow you to explain the historical returns. So that is exactly how the field has evolved. So the next factor was that I want to talk is momentum. Basically, it captures the excess return of the strong past performers. So those that have performed well in the past would continue to do well in future, and vice versa. So there are, in terms of construct, you construct it either in a relative sense where you're looking at last 3 months, 6 month, 12-month returns and constructing the momentum factor. And what was found was adding momentum to this three-factor model allowed to explain 90% of the cross-sectional returns in the equity market, and not just the US equity market, but equity market around the world as well. So if you add momentum to beta, the market beta, value and size, it becomes the famous, four-factor Fama French Cahart factor model, right? So you are incrementally adding factors which allow you to explain this residual return. So yeah, that's how momentum factor was found. Then the last two, low volatility and quality, those factors are called as market anomalies because you do not have a systematic risk-based explanation for them. I would skip the the order here. So you might be wondering, right? When I was talking about these super investors, I talked about Benjamin Graham and David Dodd, but why did I not talk about Warren Buffett? So interestingly, quality factor was discovered to explain the returns of the Warren Buffett's portfolio. What they found was, and Warren Buffett was implicitly betting on this quality factor, without the systematic framework that we are studying now. So basically, the type of companies that he was investing in was these stocks which have more stable and persistent earnings. So he was investing in companies which have more stable or less volatility in their earnings. So that is what is called as the quality factor. And you could construct it using the strength of your balance sheet, your cash flows, looking at the accruals, which are less persistent than the cash flows. So again, quality factor was discovered to explain the returns of Warren Buffett's portfolio, right? So here what you see is the stocks which have more stable or less volatility in their earnings, they outperform the stocks which have higher volatility in their earnings. So it sounds little counterintuitive, and that's why it's called a market anomaly. It could very well be that, we do not understand that systematic risk yet. There could be one, but that's more for academics to figure out. For as a practitioner, yes, you do not have a systematic risk-based explanation, but there are some behavioral-based explanations which support why a quality premium should exist. And the most important one is what is called as the leverage aversion. A lot of investors avoid leverage, or you have this other side of the investors who tend to over extrapolate the past growth or misinterpret the current reported earnings or fundamentals. So these are some of the reasons why quality premium exists. And then the final one is this low volatility, which essentially tells you that stocks which have lower idiosyncratic risk, they outperform the stocks which have higher idiosyncratic risk. Idiosyncratic risk, you could use CAPM, or you could just look at the standard deviation in their residual returns to quantify it. Again, it's the low volatility stocks which are outperforming. So there is no systematic risk-based explanation, but there are behavioral-based explanations, and the one strong one is this lottery propensity, which is exhibited by a lot of retail investors. So they essentially know that the upside, though being very large, has a very little probability of being realized, but they still go for it. And if this effect did not exist, then this whole lottery phenomena should not have existed for so long, so yeah, that's the low volatility factor. So in all, these five which are here, and then the sixth one being the market beta, these six factors allow you to explain good 75 to 80 or at times 90% of the returns in the equity market. uh, to and coming up with a new factor that would explain the remaining return is a never ending effort. So whenever you do factor research, make sure you look for these five characteristics. First, it should be persistent. It should hold across longer periods of time, because that is what would allow you to understand the risk and the premium that you harvest for taking on that risk. Then it should be pervasive. It should hold for different countries, regions, or sectors. It should be robust. It should hold for various definition. It isn't like, oh, it is this exact construct, and if I don't do that, then I don't see any premium. If it is like that, then you are doing data mining. Yeah, you're being fooled by the noise. Then it should be investable, a very important point for practitioners. A lot of times when we come up with new factors, what we find is it's essentially a rediscovery of the known factors. Like whatever you are picking up can be explained as some combination of these six factors that I just described. Or if that is not the case, then what you are picking up is what is called as this illiquidity premium. That inefficiency exists in the market, but no one can exploit it. There is this limit to arbitrage thing. So which is very important. If you're picking up on that illiquidity premium that your portfolio manager cannot use to design a real quantitative strategy, then it isn't much value for him. And I think this investability part is one thing that brings in this little disconnect between academic research and practitioners. For people in academia, they are interested in understanding these efficiencies, versus a practitioner would only care for the inefficiencies that he or she could exploit to build a profitable trading strategy. So yeah, do spend some time thinking about its investability as well. And then fifth, it should be intuitive. As we said, like you should have some sane explanation for why it works or why it should work, and then you should try to design some ancillary test to justify it. So yeah, with that, let me come to how we can some strategies which are used to put all of what we have learned so far uh, to build real portfolios. So this table describes those strategies. So first you have single factor portfolios. So essentially you are uh, building a portfolio which has exposure to this single factor, and you're hoping to harvest the unique risk premium for this factor. It's a very like a low cost strategy these days. You have products out there which allow you to take exposure to these single factors. Works pretty well. Only thing that you should be careful about is this single factor portfolio is susceptible to this factor specific cyclical drawdowns. It's nothing but the same thing that I have said before. Uh, uh, Factor doesn't work all the time, right? So there would be times when exposure to that factor could result in capital loss or would not make you money. So one should be careful about that. Then the next big thing is this multi-factor models. And I think that's the area of active portfolio management, where you are trying to exploit this complementary nature of different factors to maximize diversification. So this multi-factor approach is the core of the modern portfolio theory. So the hope is you are using these multiple factors to reduce or completely eliminate this stock specific risk. um, so you have exposure to multiple factors, and then the hope is all of them would not stop working in a given period of time. There might be some factors which are not working, but then there would be these other factors which are working and still helping you realize your objectives. The third way factor investing is done is through these smart beta products. It's more on the product side. Beta is little misleading here. It's not that market beta that we said. Beta simply means you are taking exposure to one or many factors which are out there. And when you have these factor portfolios made available to you through these low cost passive investment strategies, I think those products are called as the smart beta product. And finally, you have this factor timing, wherein you are dynamically adjusting the loading of your multi-factor model based on your expectations for the market. It's doable, but it requires very accurate forecasting, and there are enough studies which show that lot of times doing this factor timing isn't any better than a simple buy and hold multi-factor strategy. So uh, uh, you could do it, but you would have to be very, very accurate in your forecasting to make it work, or to get that extra buck, rather than just doing a simple buy and hold multi-factor portfolio. So yeah, these are some different ways factor portfolios can be built. What I have on the slide is this little exercise that I did, wherein I used our StarMine factor models to analyze the Indian equity market over the last 10 years. So I essentially built these single and multi-factor portfolios for Indian equity market, and I defined it to be top 500 names by market cap over 2013 to 2023. And I looked at their performance to see, can I use factors to understand what has been the biggest driver of Indian equity market. So the chart, the upper right chart shows the annual returns from some of the factors which I found interesting, along with the market return. So the x-axis is the time. You have the years on the x-axis, and the y-axis is the return. This blue bar is your return from the market, the overall market, equal weighted return from the market. The red bar is the return from a price momentum portfolio, and it's a long only portfolio. The green bar is for the quality, and the purple is for the a multi-factor model. So you can see that the returns have been oscillatory over time, which is very fundamental. This is again that factor specific cyclical drawdowns that I was talking about. The performance doesn't stay the same over the years, right? And if you average this performance over last 10 years, so that is shown in this table here. So over the last 10 years, the average annual return, AAR, for the market alone is good 21%. So market has done extremely well over the last 10 years. And the volatility in the market returns is roughly 27%. And then you have this metric called Sharpe ratio, which is the ratio of your returns to the volatility in the returns. It's an impressive 0.76. So it gives you a sense of the risk-adjusted returns that you're earning. If you compare it to this price momentum portfolio, it had an impressive 41% return. But then that extra return didn't come for free. You were taking on some additional risk, and you see that in its standard deviation here. It's 36, much bigger than the risk of the overall market, which makes sense. And then if you look at it in a risk adjusted sense, the Sharpe ratio is 1.15, so much better than the market. Then for quality, again, it beat the market both in an absolute and a risk-adjusted sense. And then finally, you have this multi-factor model, which is a combination of momentum, quality, and value. It again returned like close to 40%, and its Sharpe ratio was 1.15 as well. So basically, I did this analysis to show you how this factor framework can be used to analyze a given equity market. So what I concluded from here was India has primarily been a momentum-driven market in last 10 years. And if you think it is going to continue, then you could build up a price moment. You could take price momentum exposure in your own allocations and continue to harvest this premium that it has given over the last 10 years. So that is how you go about using this framework to first understand how the market has been, and then combine it with your own expectations to build your own portfolio, right? All right. So with this, I come to the last segment of my talk. So here I want to talk about some future opportunities in factor investing. Uh, I personally think return forecasting and event prediction is still going to be the two most important problems in quantitative investing. They are right now, and they would continue to be for next 5 to 10 years as well. On the equity side, I think there would be a lot of opportunities in developing what are being called as this alternative factors. So you have unstructured data like textual data, satellite images, email receipts, online reviews, and then you have lot of these ML and AI, new ML and AI techniques, which allow you to very quickly process this unstructured data and extract meaningful information out of it. So I think in the next 5 years, there are going to be a lot of opportunities of working on unstructured data using ML and AI to build these alternative factors, which could help explain the remaining returns that your traditional factors cannot explain. Of course, in terms of a career, you would have to have skills wherein you know about these ML and AI algos, and not just know how to use them, but have some sense of how they work, what are the properties of the algo, and how well it aligns with the property of the data. Because finance is a low signal to noise ratio problem. It's very easy to get fooled by the noise. So you would need good background in ML and AI, and some good hands-on experience working with unstructured or big data to tap into those opportunities. Then one more area where I think there is huge scope of improvement, it's in using this factor framework to build robust ESG and climate risk factors, and then use them in your investment decision making. What we have today is fine, but I think factor framework can be used to build more sound and robust ESG and climate risk factors, and it can then seamlessly incorporate into your portfolio management. So these are some of the opportunities that I see in equity side in next 5 years. On the fixed income, extending this factor framework in the bonds market is something that is picking up very quickly in last 5 years. So factor investing in equity, it's a mature field, I think 70-80 years, but it's picking up on in the bond markets very recently. Like, people are trying to see if the factor framework can be used to understand this bond risk premium. And the big driver for that push is this fact that unlike equities, the risk in the bond markets is more systematic in nature. So if anything, this factor-based approach should work even better in the bonds market. So that's again one area. And for both these equity and fixed income, you should see opportunities both on the buy side as well as the sell side. And then the third area where there are going to be a lot of opportunities is this active portfolio management. I think these opportunities are more going to be with hedge funds or groups that manage money, those who are registered investment advisors. So the first is going to be this alpha generation models, so which is like coming up with these new factors which help you explain this residual return that I have been talking about. And no one would want to pay you if what you are explaining can be explained by these 6 factors that we already know. So alpha is essentially a model that explains that residual return not explained by these known 6 factors that we've discussed so far, right? Because if you were to take an exposure for that, you could do it in a cheap manner through these low cost products which are already out there in the market, right? So there's a lot of research opportunities in building these alpha models. Then when you do active management, you build models for the risk as well. I don't know how many of you know about Bara. Those guys back in 80s were the pioneers. They started using factor framework to build these risk models, right? But those were linear models. So there's the huge scope of building non-linear models which allow you to characterize or estimate a risk properly. So, and then this transaction cost models again, coming up with nonlinear models, which would allow you to quantify the market impact, I think there is a huge scope of improvement over there. And then once you have these three things, then building these sophisticated factor-based portfolio optimization techniques is another area where a lot of research is being done. So yeah, these are some of the areas where I think a lot of opportunities are going to be there. And as I said, equity and fixed income, doing research either to build a product. So you could look at a lot of these sell side companies which build these products, and then you have these hedge funds where they do a lot of in-house research to improve their products. So the opportunities are going to be on both the sides. And then this active portfolio management, I think it's mostly for people who do active money management. All right. So with this, I come to the last slide. So here I want to share some non-technical skills which have helped me do well in this field. First is intellectual curiosity. So unlike pure sciences, there is no concept of you being an expert in finance. So and it's a nature of the field. So that was something that I had to learn or unlearn to embrace this field of quantitative finance. Be very careful of what is called as these unknown unknowns. So basically what it means is when you build a model, you spend a lot of time uh, implementing the objective that you're trying to achieve through it, which is very good. But then spend good amount of time or equal amount of time looking at the cases or the scenarios where your model doesn't work. And I would show you in a minute, it isn't hard to find such cases. So knowing the cases where your model doesn't work is equally important. Whether you can fix it or not, that's the second step. But exploring those scenarios where your model doesn't work is very important in finance. And if you do so, then you essentially move from this category of unknown unknowns to what is called as known unknowns. You know that you do not know these things. That awareness is very useful rather than being completely ignorant about it. So keep that intellectual curiosity alive. You never become an expert. Keep reading new papers, keep having these new ideas or whatever. And it helped a lot, and I think it should help anyone who wants to work in quantitative finance. The second is be humble. Forecasting in finance is a low signal to noise ratio problem, and it is constantly being pulled towards zero. And it's not some unfortunate coincidence, as I was saying. It's very fundamental in nature, and it's enforced by these economic uh, factors of competition and profit maximization. Forget about investors. You are a firm out there, you have a beautiful product, you have a huge demand for it, and you have very high margins. But then you cannot sustain like that forever. You have these other people who are watching you, and if they see an opportunity, they would just come in, and you would have competition. uh, your users would have more choices, and it would bring down those margins, right? Very, very intuitive way to appreciate it. So this mean reversion is very fundamental to quantitative finance, right? So be aware of it, and to appreciate it more, let us look at this aside where we are trying to see how much skill is this IC value of 0.05. Those of you who have worked on factor models or stock selection models, there is this metric called as IC, information coefficient, which is used to evaluate how good your factor model is. It is the correlation of your forecast with the realized actuals. So if your forecast was spot on, that IC value would be 1. I want to share some of my non-technical learnings which have helped me to do well in this field. So the first is intellectual curiosity, where basically there are no experts in the field of quantitative finance, unlike science and engineering. So you should be very careful of what I call as these unknown unknowns, where you are not aware of these cases where your model doesn't work. When you build a model, you spend a good amount of time uh, uh, building it to achieve the objectives that you want to achieve from it, right? But spend equal amount of time figuring out or exploring these cases where the model doesn't work. So once you do that, you essentially move these unknown unknowns to what are called as known unknowns. So there are things for which your model doesn't work, and that awareness itself is very important. Whether you can use that awareness to fix it or not, that comes later, but knowing where your model doesn't work is very helpful. In fact, a lot of my innovation comes from exploring these cases where the model doesn't work, and it doesn't take a lot of effort to know these things, and I would show you in this little aside in a minute. Then be humble. As I was saying, forecasting in finance is a low signal to noise ratio problem, and it is imposed by these economic forces of competition and profit maximization. It isn't some unfortunate coincidence. Mean reversion is something which is inherent to a lot of these quantitative finance problems. To get some sense of this low signal to noise ratio term, let us look at uh, some good stock selection model, and by good I mean something which has been in top quintile and has had a 10 years plus track record of being a good factor model or a stock selection model. So if you look at the IC for such a model, you would find IC value of 0.05. But before we do that, what is this IC? It's a metric that is used to evaluate the quality of your factor model or your stock selection model. So it is correlation of your forecast with the actual realized values. So if your forecasts were exactly same as the reported actuals, then it would have an IC value of 1. So you can see like a good factor model, like which is in top 20% and has 10 plus years of track record, it has an IC value of 0.05. Now for a binary outcome event, which is like deciding the winner by flipping a coin, IC is written as 2 times your winning probability minus 1. And you can see it like if you are playing this game with an unbiased coin, like you do a toss, it turns up head and I win, and turns up tail and you win. And if it's an unbiased coin, then there is the IC is 0. So there is no real skill needed to play this game. It's purely based on our luck, right? Because we are playing with the with an unbiased coin. If we were playing this game with a biased coin, let us say the probability of head is more, it's 20% more, it's 0.6, it translates into an IC of 0.20. Same thing, like you have 20% more skill. Here the skill is like somehow you manage to get the other guy to play this game when the coin is biased. But I mean, jokes apart, you have that 20% edge, and that is reflected in IC of 0.20. Now, in this equation, you put an IC value of 0.05 and back calculate your winning probability. You see it comes out to be 52.5. So essentially 48% of the times you were wrong. And I'm talking about a top quintile model, which has 10 plus years of track record. So it isn't very hard to find these cases. You would be wrong 48% of the time. So, be very critical of your own model, because of the fact that 48% of the times you would be wrong. But at the same time, do not be too harsh as well, uh, because that's the nature of the problem. It's not a pure science and engineering problem where you have a 90 plus percent hit rate, right? So find that sweet spot which allows you to acknowledge this fact, which is this low signal to noise ratio problem in quantitative finance, but use it to your advantage by spending some time looking at this 48% of the times when you were not right. So this intellectual curiosity and intellectual humbleness, this combination or this awareness allows you to operate in that sweet spot where you can use your expertise along with the fact that it is a mean reverting problem to build useful models, right? And the last thing that helped me was this concept of Fermiization. I don't know how many of you know Enrico Fermi. He was a physicist. He was the director of the Argonne lab in Chicago. He had this amazing skill of doing these back of the envelope calculations to some really weird problems, like how many piano tuners are there in Chicago, or how many soccer balls can you pack in a Boeing 747, and he would do that back of the envelope calculation and come up with an estimate which would be pretty darn close to the actual value if one were to do it very meticulously, right? So have that type of an approach, make reasonable assumptions and come up with an approximate answer and then just move on. Unlike pure sciences, you would never be able to put complete closure to every problem. That's not how finance works. So keep that beginner's mind, combine this outside view, which is your own expertise, with this inside view that allows you to understand the uniqueness of the problem, and then come up with something that is useful. So it helped me a lot, especially coming from pure sciences. I was always about, solving a well-posed problem with and giving it a complete closure for my own satisfaction. But that's not how finance works. And again, you can connect it back to the very first point I said, that there are no experts. There's so much that you do not know. First you figure out, and then once you know what you do not know, you would do something useful about it, right? So yeah, with this, I end my talk. Uh, Here are some of the resources that I found helpful. The first two are the books, which would get you started on basics of factor investing. And a lot of this talk was inspired or from what I learned in these two books. Then the third is this Ken French data library. So it is, you could go to this website to download these 3-factor pharma French model or 4-factor pharma French Cahart model, download the data for different factors in different markets, and can start playing with it. And then the last two are my personal favorite. These are by Grenold and Khan, and they talk about active portfolio management. So they use this factor framework to first to look at this entire process of active portfolio management. You first build factor models, risk models, and then you combine them to design portfolios with certain objectives. It's little heavy on math, but I'm sure, like, once you got this good conceptual understanding, you should be able to follow it. Yeah. So with this, I end my talk, and I'll take any questions that you have. Back to you, Litesh.
Thank you, Tarun, for that wonderful presentation. Extremely sorry for that glitch in between. As a reminder, you can submit your questions through the Q&A link at the bottom of the screen. Please submit your questions so that we can try and address as many queries as possible during this Q&A session. So, Tarun, one immediate question that comes to my mind is, in terms of somebody who is aspiring to get into quant-based investing, quant-based research. In terms of qualifications, what kind of academic qualifications do I need, and what all things do I need to have in hand so that I can participate in this particular industry and kind of grow in this industry?
Right. So uh, first, I would give you my own example. That's one way people get into the field. I came as somebody with an outside view. I knew nothing about finance. My specialization is in nanofluidics, and I think except for Sharpe ratio and maybe price to earnings ratio, I knew nothing about finance. So when I joined a hedge fund, the philosophy there was they needed guys who could build, good mathematical models, and then they would teach them finance on the job. That's one way, but I'm not saying that's the only way. So your ability to work with data, like my specialization is in stochastic processes, like how do you go about understanding these random processes, or the processes which have noise, or giving somebody a paper and to code it in Python or reproduce it in Python, you need that. But whatever you have done, it's a true phenomena and not a manifestation of the noise. If you know that, whether you are coming from engineering or from finance side, if you have that, then I think you can make a very successful career in quant finance. And to be honest, you have these technical skills, which I'm pretty sure all of us do. It could be R, not Python, it could be MATLAB or C++, but this awareness, we at least in the quant interviews that we do, we want candidates to have this awareness. Oh, this is the field that I am going to get into, like it or not. uh, we don't solve partial differential equations. I hardly do what I learned and used in my engineering. Most times it's simple regression based models, but uh, it isn't about running them. It's about knowing that what you are discovering is aligning with what has been discovered before, and it's not manifestation of the noise. I think that skill is very important in any quant job. So if you're appearing in for interviews, if you have something like that to showcase, I think it would come across as a very strong point for them to consider you. And rest of the things, if you are coming from finance background, you would have that inside view. You know a lot of the things which are very important to banks. You know what intangible assets are and how current models fail to take that into account in the valuation process. So uh, I thought it was just the outside view which was important, but over time my realization has been that outside view has to be combined with inside view. On my team, we work with people who are experts in fundamentals, like they know how to tear apart balance sheet, income statement, and they are as valuable as I am. Or we work with people who are like uh, expert statisticians, those who worked on the real life data, done experiments, and have inferred meaningful information out of it. So uh, how you fit in, or how that path sort of lays out for you, could be different. But then this is quantitative finance, and it is a low signal to noise ratio problem. If you have these two things at the back of your mind, and you have done anything to showcase that, I think that would go a long way. In terms of hiring, it has been very weird. There isn't like one straight path that people use to make into quant space. You have all sorts of people coming in, but that one thing that is common is your ability to work with data and not get fooled by it. If you are able to demonstrate that through your training or expertise, I think you would get hired. It would then be a matter of time before you find that good fit.
So in terms of typically in terms of any investment and research profile, one needs to be reasonably good at analyzing the data. So needs to be really good at Excel, and in terms of fundamental research, needs to be reasonably good at understanding the financials and interpreting and analyzing the financials. So here, in terms of these quant-based roles, is it that uh, interpretation of financials is a good to have, but a reasonably good understanding of these softwares like R and Python is a must required thing, where those are kind of being used on a day-to-day basis more than the
Yes.
just the fundamental analysis.
Yes. Yes. For data, I would say SQL. And as I said, the next opportunities are going to be on unstructured data. So doing it, knowing how to do it on cloud, it could be PySpark, Hadoop, or whatever, these technologies. So on the data side, it's Excel plus SQL plus NoSQL and PySpark, like these tools which allow you to process large amount of structured and unstructured data. Then for analysis, it's R and Python. Lately, these are the two that we hear the most. Uh, if you have a legacy system, you might be using C, C++, or you have some other, computational related reasons. But I think Python and R are most preferred for exploratory research. Uh, what else? Yeah, I think these two. And then for fundamentals, I did not know much accounting, but if you have background in that, it helps. It helps because, you know, something changes on the balance sheet, what effect it would have on the income statement or the change in the cash flow. If you have that understanding, it allows you to infer factors quickly. As an outsider, for me, it was a permutation problem. I am looking at thousands of ratios that one could blindly make and then see which is statistically significant. But if you have an understanding, you can reduce that pool to a set of 5 or 7 meaningful factors that you've decided based on your subject matter expertise. So knowing the basics of accounting always helps. uh,
And in terms of your kind of the way you shared your experience in terms of last 10 years of investing, where value investing versus momentum investing versus the returns that were generated from the markets. You shared a small table where you mentioned that what kind of percentage returns were being generated and what was the Sharpe ratio. Now,
yep.
in that, are there smaller periods where you can still change the strategy in between and try to generate higher alpha through it? Or is it that you have to kind of stay on course and stay with that particular strategy for a reasonably long period to kind of generate a reasonably good return?
So that's a great question. So for these results, it was staying invested with that strategy, even though it has not worked in recent time. That's how these results were generated. And it is something that happens in practice as well. First you have investors who have a very clear mandate. They came to you to take exposure to value. Value isn't working and momentum is working, and you would want to take exposure to momentum, but he did not come to you for momentum. He's invested someplace else for momentum. So they would want you to stick with it. And in fact, sticking with it and seeing through these hard times is what is giving rise to this premium. And it's a different story, that underperformance can persist longer than you could stay solvent. That's how funds fold. But it's sticking to your thesis and seeing through that tough period is what would give you that upside. So in practice, it's always like this. And that's why I mentioned about this factor timing. In retrospection, once it has happened, I could go back and I see, hey, momentum, quality, none of those worked in year 2018. Let me bring in a new factor that would have worked. But all of that is after the fact, right? It is very hard to do it. And if it were that easy, then everybody should be doing it, right? So it works. I know a couple of firms who've used factor timing to good advantage, but there are like very few such firms. They are exceptional. If one were to believe in factor investing and use it for our personal allocation, then building a cheap multi-factor portfolio and sticking to it should be a good enough strategy. And these back tests show that you stay invested for 5+ years, and more often than not, you end up being in green. And if that were not so, then yes, you've lost money. Then people would start contesting the value of that factor. Last 5 years, you must have seen a lot of papers, is value dead, right? Because it had not worked for so long. But that's not something that you didn't know when you were designing these factors. You have these extended periods when it doesn't work, and it is that risk which is gonna give you that upside that you're calling as the factor premium, right?
And in these multi-factor models that you'll create, now these models, there might be instances where certain factor or multiple factors are giving some reasonably better return in a period, and then they may not be performing the way they should be. Now, that overall model, how frequently would you keep on reviewing that and changing the factors in between? And Is it that certain factors work together, even though they might not work in isolation, but they work together with certain other factors and they give a better return?
Absolutely. To answer your first question, uh, uh, as a researcher, you would want to continuously monitor it and would want to revise it. But then, when you are managing real money, you have to look into this compliance side of the things as well, where they do not want you to intervene, and any intervention must be completely discussed with your investors, and it has to be implemented only after their approval. So it happens from a research standpoint. You are constantly monitoring the performance and then revising it accordingly, so that whatever you have learned from the history, you could use it to you improve it. Right. uh, Second question was uh, the the conditional improvement. I see that one factor doesn't have a standalone value, but when you condition it on this second factor, suddenly the two of them together start to work very well. It happens a lot. It happens a lot, like momentum and value, right? uh, People say it allows you to seek diversification, which is true, but the biggest advantage combining momentum with value is it allows you to avoid these what are called as the value traps. Something that looks amazingly good on value because the price itself is so low, so there is no way you would have identified it through this value lens alone. So you bring in momentum, this second dimension, and then this combination allows you to eliminate a lot of these so-called value traps. So addition of momentum, it has its own uh, uh, value, residual value, but something that it does in the background, which if you do not understand this combination process completely, you would never be able to realize it helps value factor perform much better than it would have on a standalone basis, right? So that's a great point. And lot of times you find this factor makes perfect sense, I understand it, but it is not showing me any value. The next thing we do there is try to seek this conditional uh, residual value add that you can seek from it, and it works. It works very strongly, and not with just one or two factors. There are hundreds of examples that I can give where this conditioning on the second factor has done wonders in the multi-factor model.
Right, right. One last question, Tarun. In terms of data, because factor investing requires a lot of data, updated data, and you should be in a position to slice and dice and analyze the data from all the possible perspectives. So, from where do we get this data? How easily accessible is that particular data, and how frequently do we need to refresh the data?
For getting started, like especially those who are aspiring to make a career in this field, I think Pharma French library is a good starting place. Like they have lot of data available for free, but it's historical, it's not up to date. You can use that data to understand factors, to backtest things, but you cannot do real trading with it. Once it comes to real trading, then you would have to buy it from the vendors like Refinitiv, uh, Cap IQ, or these other vendors. But for backtesting, I think you have a lot of avenues where data is either available for free, or you could use these Python or R packages to scrape data and then use it to develop a good understanding and do some backtests.
Thank you so much for sharing your insights with us today. Thank you for your participation in today's webinar. Goodbye.
Thank you. Thank you, Litesh. Goodbye,
Thank you.
everyone.